Hey, this is Brent from Wolf on Wall Street Trade with a market update for the week ending January 18th, 2019. I'm a little sick, so I'm going to try to keep this short. So it was kind of a dull week until Thursday, Friday. The S&P gained 2.87% on the week. That is, for some perspective, about how much it lost in a single day on December 24th. But we have a good counter trend rally or bear market rally. People can go back and forth whether or not it's a bear market, but it is counter trend because we have a series of lower highs, lower lows, and I think it's a good opportunity to start building up some short positions, and that's what I've been doing. I only have about 30% of what I intend to have. That's because there's certain things that I'm looking for. On Wednesday, I told members, I said, I think a lot of technical traders are going to short the market here at the 50-day moving average, and I think that they're going to get squeezed. So what happens on Thursday and Friday here? We get these anonymously sourced reports about trade deals that are retracted, but it's enough to send the market higher on both days, squeeze the shorts, and that's what happened, massive short squeeze. That's what I didn't want to be involved in. That's why I stayed out. But there are a couple of other things that I'm looking for. This bounce is part oversold, but it's also about liquidity. Here's a 60-minute chart of the SPY, right? So we got out of short positions as the market broke down through downtrends over here. A lot of people were shorting that. Very, very oversold market. Not a great idea, in my opinion, to be shorting an oversold market like that. What happened between December 24th and December 26th? Because I can tell you, anybody who's going to tell you, oh, I saw, the market was going to rally, BS. Okay, the market closed on the low of the day. The only thing that was out there that served as a warning was Treasury Secretary Steve Mnuchin on December 23rd tweeting that he is convening the President's Working Group on Financial Markets, also known as the Plunge Protection Team. So the market ended here, right? What happened on December 25th? As the markets were closed, the president, Donald Trump, who had been taking credit for every uptick in the Dow for 2 years, had been notably quiet as the market sold off until December 25th, which was a holiday, and said, I think it's a good time to buy stocks. What happened since then? Some pension fund rebalancing. Apple almost took the market lower, and then Jay Powell, the head of the Federal Reserve, goes dovish on the 4th of January right here, sends the market higher, sends the dollar lower, volatility down by something like 50%, extremely complacent, and the Chinese central bank, the People's Bank of China, has dumped about 1.6 trillion yuan into the market over here. So there are technical aspects. We have an ascending wedge here, which is a bearish price pattern. But this is about liquidity and flows of funds, and that's why I keep saying pay attention to what the bond market is doing. Here's the 10-year yield overlaid in white. So it knew something was going on here in December with a big rotation into treasuries. Market sold off. It seems to have known that Apple was going to come out with that bad report because they flash crashed. Yields flash crashed. Currencies flash crashed. And then we have Powell going dovish here, which sends treasuries lower, yields higher. This is what I was saying last week to pay attention to. And one of the things that I have been pressing since I think about January 9 was what the bond market was doing, and specifically TLT, kind of the long end of the bond market. So here's a 60-minute chart of TLT. It has been trending up, monster trend, as the market's been selling off. And what did we notice was this break right here. This is around Powell and a little bear flag, and I said that I think TLT is going to go to 120. Matter of fact, I'll give you the actual excerpt that I posted for members on January 9th. This is the actual excerpt posted on January 9th for members on the member site. So for TLT to pull back to 120, because TLT was not there yet, it was just starting to, I get about a 5 basis point gain in the 30-year yield up to 3.08%, and a similar 5 basis point move for the 10-year yield up to 2.79%, and that gives me a rough target of 2640 to 2650 for the S&P, which would be the area of massive overhead supply from the October to December consolidation, or roughly 2% higher. So the gist of that is TLT was right about here on the 9th of January, and I expected it to pull back to about 120. I actually revised that lower the next day to 119.75. And that as long as that was happening, I didn't expect the market to break down or do anything unruly on the downside. And as a matter of fact, it could even go higher. So let's see what happened since January 9th as far as those forecasts. From almost 8 days ago, the 10-year yield is at 2.78%. And I was expecting about 2.79. The 30-year yield is at almost 3.10%, and I was expecting about 3.08. And the S&P is at 2670. My estimate was 2640 to 2650. So that basically just told me I didn't want to be getting aggressively short the market. In a couple places I built some positions, but as far as the market averages, I didn't want to be getting aggressively short because the bond market was still pulling back. And that, I think, is one of the number one things you should pay attention to in the next week. What is the bond market doing? We have seen volatility go from pretty high to extremely complacent. VVIX, the volatility of VIX, making a near 2-year low, finishing the day with a little bit of a hammer. And VIX itself has lost 50% since December 24th over here. But I saw something interesting. I follow term structure volatility a lot, and right before the contract roll on Tuesday I saw some relative strength building over here, and we have a little doji over here. The percentage of S&P 500 stocks above their 50-day moving average has gone from extremely oversold down here at about 1.5% up here to about 69%, where it tends to be at a level that's more consistent with a market that's, well, let's say at least not oversold. Another thing to pay attention to, if you don't have your own research team of 50 people that can track global data every single day, is the Australian dollar. This is the Australian dollar versus the US dollar, a daily chart of it, and I'm going to show you why I think it's important. This is a currency that is sensitive to Asia. It is sensitive to global trade. Let me show you what I mean by that. In white, I have overlaid the MSCI All World Index, excluding the US, and what was the Australian dollar doing? Earlier in 2018, I looked at this trend. I said, this looks very deflationary. It does not look good for risk assets. So this is global markets. What have they done? They followed it lower. What did the S&P do? The S&P ignored it, and it went higher on this ridiculous narrative that trade wars were good for the United States until the U.S. realized the rest of the world was slowing and the U.S. sold off. I follow this as a barometer of risk and a barometer of what is going on with the trade wars. And this is what I have been showing to members on a, let's say, a 60-minute chart. So here's the flash crash with Apple's earnings, their revenue guidance warning. And here is the Powell pump moving the market higher. And here is AUD, the Australian dollar, not as enthusiastic as U.S. stocks are. In fact, if we take a closer look, this is a 5-minute chart of the Australian dollar versus the US dollar in candlesticks, and S&P futures here in purple. This is Thursday's trade war rumor, right? So stocks and the Australian dollar both popped on that. They both bought it. Then we get another trade rumor on Friday. Stocks buy it. The Australian dollar does not. As a matter of fact, it closed at the low of the day. Watch what the Australian dollar is telling you. It bought the first rumor, did not buy the second rumor. Watch what the bond market does. Do treasuries start to find some support here? They've reached my target. This is my own indicator, 3C on the SPY's chart. And we've been getting pretty good confirmation, except when the S&P moved above about 2,600 and then about 2,625, but not strong distribution there. It's just not confirming as well. And we're in that kind of target range as far as what I was expecting for treasuries. IWM's a little different. IWM showed some weakness over here, and it has not been confirming well. It did get a boost on those trade rumors again on Friday, but I am seeing more non-confirmation, maybe a little bit of distribution going on there. And that wouldn't be incredibly surprising because the S&P is into this range of overhead supply. I think this is more about flows than it is about technicals. Blew right through that 50-day average. Shorts got squeezed. I think it is a nice opportunity to be getting some short exposure, but know why and when and where. So IWM is looking a little bit more interesting over the last week. And just as important is, what is the bond market telling you? What is the bond market doing? Is TLT and the rest of the Treasury market going to find support here where basically we had our downside target? To me, that is the fundamental key question and the fundamental development in timing short entries, or at least ramping up exposure, because I've already started entering some short trades. I hope that wasn't too much and too confusing. If you're a member, you see this stuff every day, so hopefully it just helps to see it on video. Have a fantastic weekend. Remember, the market is closed on Monday for Martin Luther King Day.